So let's talk about some additional considerations that we will cover today. Basically, this is a style of trading that I can enter one time a month, and it's non-directional. As you already know, non-directional means that I will be hedged. I will be buying a call option and a put option. I don't know where in the certain given window of time in the month the market's going to go. So if I don't know where it's going to go, then why don't we simply participate being in a hedged environment? And yeah, the entry date is very specific, and then you'll understand what I mean. So we want to know, well, when do we enter? What is the time of the month when the stock is getting ready to make, or the market's getting to make its more pronounced price movement for the month? I need to know when that is so that I can position myself ahead of that move and be able to capitalize. And then, of course, when will I consider exiting? That is always something that I'm very passionate about. I like to have exit strategies in my trading that are based on one of two conditions. Either a price target is being hit or my time in the trade is here. Remember, we trade options. Options are truly time sensitive. So speaking of options, which ones should I consider? How much time should I have on the option? I'm going to be in the trade, maybe just a few days, maybe a few weeks. So how much time on the option? And at what strike price or strike prices should I look to purchase? There are certain months where the style of trading is not conducive or consistently profitable. So we need to identify what those months are, and then we will consider passing. Because remember, if I do something in January, and then January I'm successful, and then next January successful, next January successful, next January I break even, then the next January I'm successful, and the next one I lose a small amount, January will always be a month that I will look to trade. At least giving you the heads up there. But if there's a month that I make money one month, the next year I lose money, the next year I lose money, the next year I break even, the next year I make a little, the next year I lose a lot. Now you know that maybe that month is a month that I really probably should avoid because it has maybe certain environments that are not making it conducive to a more sustained price movement. Because even though I want to see it move, that's the key. It has to have a sustained price movement in one direction or another. I have some case studies or some results that I wanted to share with you and talk about how do I know at any given time what instrument do I trade. I'm going to look to enter a hedge position on the first trading day of the month. My option will go out at least 3 to 4 weeks of time, depending on when the FOMC is slotted in that month. Of course, if there is a fifth week, yeah, we may have to go out a fifth week. Now that's really going to make it a little pricey, or I can go 4 weeks and plan on getting out well before. I will calculate how much the ETF or the index is going to move and compare it to what I'm going to pay. If the trade, and this is rare, if it takes me all the way to the week of the expiration, then of course I want to close it out by Wednesday. And I look to avoid these months of April and May and December. I call them sleepy months only because they really, they're not consistently profitable. So I think May would have been, April would have been, I'm not too sure. I don't know, it's hard to tell. But that's also the beauty of having 8 treasures.